Hello, how are you doing, guys? If nobody's going to join right now, so I'm going to switch to presentation. By the way, before I start probably and show the slides and everything. Now, tonight we're going to cover a very interesting company, and I presume practically everyone probably knows this company. It's called Discovery Communication. They had some changes in names, but always Discovery, okay? And it would be entertainment industry. Now, during our previous master classes, we already discussed that industry, and I presume you already, like, if you learn with us, you know them. We looked at Disney and Foxtel. We looked at other companies as well in that particular industry. And tonight we're also going to look at this industry, but we're going to pay attention what kind of changes happened during the last year, which affected this industry. And because there are different type of business models in this particular area, we will see what businesses were affected in a bad way and what businesses were affected in a good way. And then we'll look at a specific company, Discovery Communication, and we'll try to kind of understand how to deal with it. Should we invest or shouldn't we? Okay, so in this particular case. First of all, the disclaimer, guys. I presume you understand this is masterclass. We're going to go and cover the real company, and you have real money. So, and if you decide to invest, you have to understand that you invest your own money. And this is masterclass for people who already know what to do. They understand how to invest. They understand how to allocate money. So if you've never done it, I definitely recommend you to, before you invest, you have to fully understand your approach, your strategy, your plan A. So when you invest in stock, so what's your plan B? So when you're going to exit from that stock, what happens if the stock goes down? So what kind of actions you're going to take? Maybe it will be a stop loss, maybe it's selling call options, but you definitely have to know that. And remember that you're fully responsible for whatever actions you're going to take. Okay, and even though if you like this company, you still have to analyze it before you place any decisions, place any trades. Okay, please put pluses that you understand it, or for Zim wrote to 10 to acknowledge that you understand this particular situation. It's not the advice which I'm giving you. It's like educational webinar where I'm showing you my way of thinking. Okay, how I pick the stock, and of course my approach to that particular company. All right. Usually what we do, we run first few minutes, we go through overview of the market, because it is very important to understand what is happening right now on the market and what we can expect from it. And the main reason for that, because like we're going to go through indexes, you will see when the index is falling, that's what we are saying, that market is falling or market is growing. Indexes, they consist of different companies. And the first index is Dow Jones. It consists of 30 biggest companies by capitalizations. The second index, S&P 500, consists of 500 companies, small, medium, and large size. And of course, when you see that index is falling, it means that in general, all shares of those companies which are included in that index, they're falling as well. And you can expect, even if your company is fantastic and great and pretty good, the way market works, that there are a lot of ETFs, industry ETFs, and people trading on them. And if they see that the market start dropping, what they do, they close position, they exit it, they start selling it. So, and of course, that index has to sell, like, I mean, that ETF has to sell those companies or part of that portfolio to sell. And what happens that it drives the price down. And a lot of people who trade and pick individual stocks, they kind of don't understand it, because they don't see any bad news about the company. They know that company fundamentally good, but still the price is dropping down, and it can be really frustrating. And so why is that happens? And for me, it took a few years to get to the point when I realized that I have to pay attention what is happening in general, okay, on the market, and then I'll really look individually in any particular company. So that's what we're going to do. Then we're going to look at industry, and then we're going to already look at specific company, okay, and then a couple news about the company and future events which we're going to have in the future. Now, Dow Jones. Dow Jones is the index which includes in itself 30 biggest companies by capitalization in the United States. What we can see, this is a chart which represents the price move for those who just knew. And we can see that in March of this year, we had a huge drop when like people become worried about pandemic. And since that time, we recovered. Practically, we did get to the maximum point where it was before the fall. Okay, we just a tiny bit, we didn't reach that level. And as you can see, we pulled back down. Then we moved up again. And as you can see right now, we kind of consolidating on that level, but still it's kind of downtrend. We already can see that it's kind of downtrend. And I wouldn't be surprised if tonight we will see that move down. And very, very possible that the price of Dow Jones will go to somewhere to the bottom of this yellow trend which I identified. Of course, it might slow down on that line, which is 27,500, because it was previously quite good like resistance, and then it was few times a support level. Okay, so we can slow down it here, but I wouldn't be surprised if we drop down to the bottom of the yellow line, like yellow trend, and it's roughly around 7% of drop. Of course, it can go all the way down, because personally, I believe that the market is overvalued quite a lot, and I'm going to show you why I think like that. And it's kind of gives certain perception that if something happens in the market, and there are a lot of things can happen right now, it can trigger the fall, and I wouldn't be surprised if we see something like that again. Okay, and I'll show you in the future why I think like that. Now, if we go for closer look, that's what we can see. That was the maximum, which was in September, and after that we can see those huge red candle, and then it's dropping down. It's actually showing us how people prepare to sell off. Okay, when we see something like that, it gives us understanding that a lot of people, they are waiting for this fall. And as soon as they fall, like, I mean, the market start turning around, they started exiting from their positions, and they start shorting a position. So look at this particular, right? So we see huge red candle and then couple of days recovery. And again, one red candle, which covers practically 2 days of growth. So the fall happens 2 times faster than the growth. So if we see it tonight, so definitely we can go to this level. This is the thing. So definitely, guys, be prepared that to see this fall. And if you look at the indicators, you can see that majority of them in overbought situation. So people will be and already turning. So we can see that sell-off started. Okay, and it's kind of slowing down. So definitely it might happen. Now the second index, S&P 500, which I already told includes 500 companies, and those companies, they are small, medium, and big size. So personally, I believe that this particular index represents the whole economy much better than the Dow Jones, because I mean the economy consists not only from like of big 30 companies, right? So it consists of many small companies, and very often that during different economical like situation or recessions, some businesses, for example, big businesses might suffer more, and in another situation, vice versa, small businesses will suffer more, and big businesses otherwise they will survive better. Okay, but look at them. The trend looks very, very similar to the previous chart, and also we can easily expect that the drop might happen to around 3,200 point level. Okay, now again, look at this candle. It just slowed down on the previous resistance. So you see, this was the highest point here, and now it's become a low. Very often, when you analyze price like charts, you will see something like that, you know, so patterns. And again, all indicators, they're showing us that the index already in overbought situation, and we can see that's turning. So people started selling it off, and kind of the direction changed. Okay. Now, when we look at Compaq or Nasdaq 100 index consists of 100 mostly tech companies. Okay, and very often this index moves in a different kind of pattern than previous two indexes, because like recently for the last 6 months, as we could see, a lot of IT companies, they actually performed quite well compared to other businesses which like perform, especially retail industry, which quite a lot included in Dow Jones and S&P 500, right? So Nasdaq performed much better, and also it's dropped down in March. The price of Nasdaq dropped down, but after that it's recovered much more. And at the moment, this point was much higher than it was in February 2020. Okay, but currently we can see exactly the same pattern. We see again for the last week, kind of it's slowly going down, and definitely I wouldn't be surprised if from 11,600 we're going to drop to around 10,500. Okay, so somewhere close to this level. Again, those levels where you see red lines, those levels where we might see this the slope of the drop. Okay, kind of some kind of consolidations on this particular trend. This is Nasdaq, and another index which we're covering usually it's VIX, volatility index, and it's kind of index of fear. And when the fear is high, it means that the prices of previous indexes, they are low. So when they're dropping, people very fearful on the market, and volatility is high, and this index moves up quite a lot. Okay, that was a fall in March, which happened like last March, and we can see that volatility index during that time increased quite a lot. So like the fear was extremely high, and also we can see that last night the markets, like previous indexes, were dropping down, and this index went up instead. Okay, so they always work in opposite direction. So if Dow Jones is going down, so volatility index most likely is going to go up. But you can see the pattern of the chart a bit different, and we can see it's kind of sideways. Last year in 2019, I don't have the chart here, but we definitely see here that the range high and low was between 9 and something like 15, in that range. Okay, and as you can see this year, people, it's more volatile market, first of all, and secondly, as you can see, people are more fearful of what happens, and the lowest point was around like 20, right? 20 to 29 in this range, and a few times it's reached quite high levels, which even wasn't before previous. So it gives us certain ideas that even though a lot of money on the market, and people still putting money on the market, but a lot of those traders, they kind of prepared that the market might turn direction, and believe me, they will start shorting quite a lot, so they will move the market even lower and faster down. So you have to be aware of that. Okay, and of course it will drive the drop of the price even lower. So that's why when you analyze indexes, you have to understand why you're doing it. The major thing is like before you, for example, you transferred now $10,000. What will you do? Are you going to put money right now, today, or you're going to wait when the index pulls back down? So if you understand the general consensus, what is happening in the market, you understand that election is coming up, right? Earnings reports are coming up right now, and you think, okay, what kind of reports we can expect now? Is it going to be good or is it going to be bad? And you think, okay, some companies already reported, and the reports are not that good, and you kind of, and also they're reducing their earnings projections for the next 6 months. Or some companies, they completely eliminated those projections. They tell you, we don't know how much we're going to make. So it's like uncertainties on the market. How people are going to respond to that? Yeah, and if we see this pattern continues, so most likely we will see this drop, especially with the elections. Usually during the election, the market is really volatile, and we don't know how people will react on that. And any of these particular points can trigger the drop, the changes, and then already it's like emotional consensus of the fear might drive the fall even further. Okay, something like that. Last year, remember, in the beginning of 2019, there wasn't any particular reason, completely, there wasn't any fundamental reason for the drop, but the market just started sliding down and dropped nearly 18%. And a lot of analysts, they were discussing this situation, and they were saying that there is no real even trigger for the drop, but the market still was dropping down and then recovered pretty quickly. Okay, so you have to be aware of those type of drops, because if you put money right now today, for example, you might expect that your portfolio will drop down 7 to 10% if the market drops 7 to 10%. So it's like normal situation. And of course, if you're not prepared, how are you going to feel? You're going to feel like, oh my goodness, I put $10,000 and now it's only $9,000. And you might think, oh, investing is not for me, but it's normal pattern, right? But if you're patient enough, and if you understand this type of situation, you wait until the general market drops down, and then already out of the list which you prepared of the companies which you want to put money in, then you start buying them. And in this case, when the market recovers, your company, if you chose it correctly, it might recover not only 10%, it will maybe 15 or 20% or more. All right, this is type of important part. Guys, can you please put from 0 to 10 how you understand the reason why we looked at the market? And then we'll continue to the industry itself. Okay, by the way, I also wanted to show you why I believe that market is overvalued, because I mean, if you're investing in business, you understand that. Why would the price of the business start growing up? There are two major reasons. One, the business performs better, so that particular business makes more money. Okay, another reason, that more buyers come in, and more like the business might make exactly the same amount of money, but people believe, oh, it's going to do very well, and what they do, they're happy to pay more money for the same type of earnings, right? So, and the business becomes overvalued, so the price for that business grows without even growing in earnings. So that's what's happening right now with the market. So I'm going to show you this ratio, P ratio. Guys, if you don't know what it is, please let me know and I will explain you. If everyone knows what it is, I'm not going to go into details and explain what it is, but I'm going just to show you. And by the way, there is no embarrassment if you don't know that. It's financial like ratios, and if you never learn that, why should you know about it? So please, if you don't know, let me know and I will explain you details. But the main thing here, look, this is today, right? October 19th, or like Monday. Last year, exactly 1 year ago, price-earning ratio was 19. It's for Dow Jones Industrial Average. It means that for each dollar which that index was making, people were paying $19. Remember that index consists of different companies, right? And what they do, consolidated earnings, how much all these businesses make. And if you take $1 for earnings, people paying 19 times in average last year, okay, on that particular day. Now, today, like last night, they were paying 26 times more. For this, so imagine if exactly the same earnings happens right now, the company is making exactly the same, but people paying not 19 times, they're paying 26 times. So $7 more for each dollar of profit. And if we compare that, it's about 30%. So the index Dow Jones, 30% overvalued compared to the last year, same time, okay, in October. Now, if we're going to look at NASDAQ and Standard & Poor's, the situation is similar. So we can see that NASDAQ was 24 times of their earnings. So they pay $24 for earnings, for $1 earnings. Now they're paying $36. So it's again, more people putting money and the price of that particular index went up without growing in earnings. And also similar situation happened with Standard & Poor's. Okay. Very, very similar situation. Now, guys, if we compare with the even previous masterclass, which we had in July, we see still same growth. Look at this. Dow Jones in July was P ratio was 22, now it's 26. If we look at Russell, like NASDAQ, it was 20. sorry, it's kind of, this thing is on my way. 33 and 29. Okay, and now we have it 36 and 38. So much more. And the reason why we have to pay attention to that again is just because if in general people always pay, like big institutions, they pay attention to those ratios and they understand when they have to buy and when they have to sell. And this, if this ratio becomes too high, they start selling it off. Okay, and there is a lot of course, manipulation happens in the market. So before they have strategies to sell, remember, so prior to that, they might come up and they will tell good news, and people will have positive kind of incentives. And the reason why they're doing it, they kind of manipulate the perception of everything is good, and they start selling off. And a lot of people are buying at that time, and they can get rid of their assets at the highest price. So you have to be prepared. And exactly the same vice versa. When they want to buy the market, they actually place in a lot of news on the media, which kind of creating a fear. And then as a result, they be able to pick the stocks without moving the price up quite a